get into a home. And Ken actually knows that that's not entirely true. So I'm going to turn this over to Ken Yelin. Ken, we've got a couple of people on the Zoom feed. I've also got a handful of people on our second feed, which is funneling through Facebook. As those questions pop up through Facebook, I will, try to divert them over to you and such. But right now, Ken, I am actually going to make you the host. So if you want to share your stuff and all that, you will be able to do so. And I will sit down, shut up, and pay attention to exactly what you're teaching us. And I'll let you operate. How does that sound?
Sounds great. Sounds great. Thank you. Well, good morning. My name is Ken Yelin. I'm with One Trust Home Loans, New Mexico, NMLS number 779952. It's important to have that quality number out there. So this morning I want to talk about a couple different programs that can affect us or help us buy a house with very low down or actually no money down on one program. The first one I'm going to talk about is a program called New Mexico Finance Authority, or MFA. And the MFA program has an excellent program called First Home. And the First Home program is a program where you basically need about $500 down into the transaction in order to buy a house. It's a great program. One of the aspects of it is you must have a credit score of at least 620. As far as it goes, though, the 620 credit score and above is great. This is exclusively for first-time home buyers, used to finance single-family properties only. It can be a manufactured home on permanent foundation. As I mentioned before, requires $500 contribution from the buyer's own money. You can't borrow the money. You can't get a gift from family members. It's got to come out of your pocket. You have to have home buyer counseling, pre-purchase home buyer counseling, which is really excellent. The home buyer counseling goes through various different budgets and how to make sure that you can continue to make the payment on a house and not have problems and issues with that. So it's an excellent course to take with that. Now, again, the first-time home buyer definition is somebody that has not owned a home or occupied a home in the last 3 years. So let's say if you were married and you were not on title on that house, but your spouse was, then you couldn't buy a house with a program. You'd have to go with a different program, which is possible. But if you have not owned or had any ownership of a home in the last 3 years, then you can be on this program itself. As I said, only single family homes. We can use what's called alternative credit sometimes with the program. An alternative credit might mean that we might get 12 months worth of proof that you pay Netflix on time, or car insurance, or maybe your health insurance, or some other thing that you pay on a monthly basis. But it's an excellent first-time homebuyer program. It does have income limits, which we have to pay attention to. So sometimes you might find that you don't qualify for that because you make too much money. In the Gallup area, if you're a single person, the income limit's $60,400. But if you're a family of 3 or more, the income limit's $69,460. So that's total combined household income limit. But it does include, let's say if mom lives in a house and collects Social Security. So it'd be, maybe husband, wife, incomes plus mom. So we've got to look at everybody's income that's going to be in a property itself. So it's an excellent program to get started with. I have some more notes over here. I got to refer to my notes real quick. Here we go. So the program itself is a combination of an FHA first mortgage, which requires 3.5% down payment. But the mortgage insurance, the MFA comes in and will do a second mortgage up to $8,000 over 30-year payment, which the maximum is going to be about $48 a month, but up to $8,000. So you can use that $8,000 towards your down payment of 3.5%. Now, if you do find that the seller is willing to pay some of your closing costs and prepaids, and I'll talk about that in a minute, then it is a possibility you can buy the house and basically only need $500 into the property. I do want to touch on a little bit about what is prepaids and closing costs. So a prepaid is money that is paid to make sure you have tax insurance that are paid for the property on a monthly basis. So up front at closing, you're going to need a full year's of homeowners insurance. You're going to need at least 2 more months additional homeowners insurance and at least 3 months of property taxes. And those are considered prepaids. Closing costs are all negotiable, but the closing cost, the MFA program does have some what they call points or fees. And then your other closing costs can be whatever the title company might charge. So the title company is going to charge you maybe half the closing fee or title policy fees or recording fees and that sort of thing. So when you get started with the whole loan program, what I like to do is normally is take the application and get it started. And just as a point of view, my website is www.kenyelin.com. That's KENYELIN.com. But if you put in an application with me, what I can do is I can go ahead and see what you're pre-approved for based on your income and your credit scores. And then we can do an estimate. And part of the estimate is going to show all the closing costs and those prepaids I just talked about. And that in itself, you'll be able to have a perception of whether or not, if you buy a house about $125,000, then the MFA first and second mortgage usually covers the majority of the closing costs and prepaids. If you buy $175,000 to $200,000, you're going to wind up coming out of your pocket with some money or seeing if you can get the seller to participate with paying some of your closing costs. As Jason will tell you, the market right now with the sellers, just in a great position as a seller, there are a lot of them not paying those closing costs. The beauty is, though, you can get a gift for those closing costs from a family member or different aspects. There are places that give grants and that sort of thing. So there's an opportunity to get that also, which would help you overall between either the gift from a family member or a grant or the seller paying the closing costs. Like I said, but with the MFA program, as long as you don't exceed the income limits, there's great opportunity to buy a really nice house in today's market itself. Let's see. Let's check my notes real quick and step all the things real quick. Make sure I'm not forgetting anything I wanted to share with you about that program. There is a website. It's a long website. If you email me or if you do go ahead and apply, I'll share the website with you for the First Home program. And that website will give you a lot more details about what I'm discussing right now. Something that's part of the loan that we have to talk about, most people don't understand, is something that's called mortgage insurance. So unless you put 20% down, then mortgage insurance is required on your loan. And mortgage insurance is a fee you pay to the lender to make sure that you don't get foreclosed on. Now, under FHA program, with the FHA MFA combination, FHA sets that mortgage insurance fees and costs. And that'll be part. So when you make your house payment in the future, it'll be the principal and the interest, the taxes and insurance, the mortgage insurance, and the second payment itself for the MFA second mortgage itself. That pretty much covers anything. Jason, is there any particular questions going on right now at all?
No, I'm not popping up. Of course.
Sorry, guys.
What is that noise in the background?
That's my big dogs barking at nothing.
But actually right now, and we're going to let the second feed catch up to us here a little bit. But Ken, I think the biggest question people may be having right now, so what you're telling us off of this first section, and I'm sorry, I had to go grab a cup of coffee here right at the beginning. But what you're telling us is that there's a perception out there, a myth out there, that you need to put 20% down in order to buy a house. And this first program that you gave us, which was New Mexico MFA, you're telling me that I don't need to put 20% down, which is really quite remarkable. What's the value, Ken? I mean, buying a house now, I might have to use the MFA program. I might have to do private mortgage insurance. I might have to have this second mortgage from MFA. But why would I want to take on that responsibility now, as opposed to continuing to save in order to get, let's say, 20% down?
Well, I don't know about you, but life is expensive and it's very, very hard to save 20% down, especially if you're looking at a $200,000 house. I mean, that's $40,000 plus any closing costs. The fact of the matter is that 20% down is great if you've got it. 20% avoids mortgage insurance. But that's the only advantage. Maybe you might get a little better interest rate or maybe a few other things. But the fact of the matter is that there is absolutely no reason why anybody needs to come up and sit back and save that much money. I mentioned the first time home buyer program. MFA has another program called Next Home where, they've got a different program, but it's very similar down payment situation. And your income limit is $91,000, which is sufficient for a great amount of people. So we could definitely get in a program. But, Jason, you're absolutely right. There is no reason for people to wait. If somebody waited to come up with 20% down, the great example is let's say somebody started 10 years ago trying to come up with 20% down. They could have bought a house in the Gallup area that today might go for 200,000. They could have bought it for maybe 150 or less. So they're losing out on the opportunity to gain equity. One of the greatest things about owning a home is definitely going to be that, number one, you get a tax advantage. You get this tax deduction that you don't have to pay as much taxes, comes back, which is nice and great, but that's not the main key. The main key is that overall down the road, you're going to build equity in a house. If you bought a house 30 years ago in Gallup, I bet that house, you could have bought it for maybe 60,000 and it's worth 200,000. I mean, that's building your retirement. That's building your future. That's building, if you need to move from a different state, then you've got money out of the house and opportunities. So waiting is really a mistake. And also, what's very important is that the interest rates are going to go up. Now, I don't really know how old I am. You can tell I got a couple of gray hairs here, but I've been doing this mortgage thing for over 30 years. And when I started in the mortgage business, the interest rates were over 11%. And the payment difference between 11% and maybe what's 3 1/8 right now with MFA rate, and that's not including the APR and that sort of thing, but it's just the basic rate, is a massive difference in a monthly payment. Well, right now, the market is going up and rates are going up. We enjoyed lower rates for a long time. And like I said, 3.125% rate is still extremely low. But the fact of the matter is 6 months ago, the rates were 2.5. So they're definitely creeping up. And what happens is to buy that same, let's say you buy a house, 150,000. Well, now the payment's gone up $40, $50 a month between the two different rates. And so it's not as affordable. So you have to wind up buying less of a house based on what you qualify for. So the time is of the essence to get the house now. I know shopping for homes is really difficult right now, but there are, sellers that are willing to sell and buyers that want to buy. And I think that both parties will come together, but I think it's a wonderful, and if you wait, you're just missing out on an opportunity for yourselves and to gain equity in the future and have a much lower payment.
Well, and Ken, you mentioned a great thing here, building equity. And if you guys really want to see how quickly equity is going to build, this is for the public information here. Between 1 and 2 p.m. today, I actually have a presentation called Maximizing Your Real Estate Investment. And, in that presentation, I'm going to show how quickly you can build equity. For most people, if you're going to buy a $150,000 home, in just 5 years, you're going to gain about $34,000 equity. And, I think that's what you're getting at, Ken, is for me to save in 5 years, $34,000 of equity, that means I would have to save roughly $600 a month just to be able to get that kind of equity position. And most of us don't have that additional $600 of going to sale per month. So or going to, into the bank account every month. So that means that we can use our home as a leverage position to be able to save money faster, even though I might have a mortgage insurance or a second small mortgage on this property.
Absolutely. And, you're going to find that I heard what you said. I read that rumor a couple of times in the mortgage industry that people are expecting to have to put 20% down. Like I said, I've been doing this 30 years. MFA created programs, I think it was 25 years or so ago. But the most at the point in time years ago when I first started was maybe you need 3.5% down. So we're talking, that rumor has got to be squelched. That's just, it's sad that people are sitting back thinking, hey, I can't do this. I do want to circle back around to people and their credit scores. You and I have both worked with a lot of people that in the past, they're sitting at home right now thinking, well, my credit score is 580 and I really, I just can't buy a house, or, I had a mistake, or, I had bankruptcy a few years ago or something of nature. that's okay. We could set a plan. If somebody's out there right now and has credit score issues or maybe an old bankruptcy or something, I had a customer recently that didn't want to buy a house because they thought they had to have 10 years after a bankruptcy. Um, that's certainly not true at all. I mean, exactly. Yeah, you're holding up with number two, but FHA is correct. Number two, I mean, so you had a bankruptcy a couple of years ago and you have recovered and you've gone out and reestablished credit, then you don't have to wait to buy a house. So there's opportunities upon opportunities. There's no reason to rent. Rent payments are very high, and there's a lot of people that are qualified to buy a house. I mean, I can imagine, hey, I'm paying $1,000 a month in rent. Well, what's that going to buy me in a house? And then my house, and now I can work in the backyard. I can fix things up. I can change things. I don't have anybody's permission to do these kind of things. So it's really exciting owning your own home. Yes, it's got a little bit more responsibility, but man, what an opportunity. As you said, building equity and building the future. My parents are, for example, they bought a house almost 20 years ago, and my dad's, thinking, I don't have much equity. And I looked it up for him, and he's in Portland, Oregon, and he didn't realize he built $250,000 in equity in the last, some odd years. That's a lot of built up. I mean, we don't know what the market's going to do. It might stay flat. It might not go up, but right now the market is going up and it's well. And, but even if you waited 30 years, like I said before, the house in Gallup you might have bought for $50,000 20 years ago is now worth 200,000. So it takes time sometimes, but what an opportunity. But if you find yourself in a situation where your credit's not the best thing to do is go online, put an application. Again, my website is kenyelin.com, and it's Yelin was spelled with Y-E-L-I-N. But go online, apply, and I'll pull your credit report. It won't cost you any money. And I can see if you're in a situation. And if you're not in a good situation, I'll send you a quick email or phone call. We'll talk, and I'll just let you know, look, hey, you know what? You probably might want to get some credit repair done. Or, if you go out and get a couple credit cards, that's a good example to talk real quick. I mean, people go out and charge with these credit cards. Well, they're trying to reestablish credit, and they'll go out maybe to Capital One and get a $500 limit, but they'll charge you up to $400. Well, that's not building your credit. That's actually hurting your credit. You got to keep that limit to 33% of the $500. So you keep the credit card about $125, but never pay it off, pay it down and just cycle that, get 2 or 3 credit cards. I've watched people credit scores go from 580 to 620, 640 in 3 or 4 months, simply because they open up a new card and are using it. It's not people looking at things anymore. It's just a computer model, and you can fool the computer by just doing simple steps. And so we can definitely help you with that. Our goal is obviously as a team with Jason is to really help people out there get into their home and set up. If it takes 3 or 4 years as a team for us to help you get into a property, that's okay. There's going to be houses down the road. There's going to be programs down the road, and we can help you do that. But, today's the first day to get started. Don't be afraid of it. I know a lot of people are afraid of calling me. Speaking of which, if you want, 505-220-2968. 505-220-2968 is my phone number. You can give me a call. We can talk. But most people are afraid to talk. They don't want to be disappointed. But if you do the online application, you're really not risking that much. And I think we can really help you find an opportunity to go ahead and get set up for a home loan.
Yeah. Well, talking about the credit scores, we're going to have a presentation later this afternoon, 3 p.m. to 4 p.m. Dale Diedrich from First Financial Credit Union is coming, and he's going to teach us how to read a credit report and how to improve and maintain your credit score. So even if there are obstacles, our extended group, as we're coming through the Gallup Housing Summit, representatives like yourself, Joy Striley, Caliber Home Loans, and Dale Diedrich are coming together really for the general good of the community to try to be sure that everybody has this opportunity to be a homeowner. All right, so we've talked about MFA. We kind of went off into the weeds a little bit. What else do you got for me today, Ken?
Well, I just touched on a little bit of the program called Next Home. So let's say right now you do own a home and you have just a little bit of equity and you're going to sell it and buy another property. Well, the program called Next Home does allow us to go up to, like I said, the income limit of 90,000, which is great. Next Home, you could own a home before. Maybe you move from one city and move into Gallup, so you don't have to be a first-time home buyer, and which is great. And the Next Home program is a little different. It gives you a grant of money, or here's some free money. You have to live in a house for a certain amount of time, Again, I'll share the link to the website so you can read more details so I don't misquote anything. But if you live in a house a certain amount of time, they're going to give you up to 3% of the down payment of the house. That's free money. What a great program to have. The rate on that's a little bit higher. Some of the details are higher, but overall it's a really great program. And like I said, the income limit's $91,000. So that's a lot of extra money. The other program I definitely want to touch on, which was my go-to program before COVID started, was the USDA home loan program. I love USDA. The flexibility has tightened up quite a bit. You have to have a really strong portfolio, but the USDA loan is a zero down loan program. It's an excellent program. So if you're in a situation where you don't have a lot of money, but you can get into the property, it's 100% home financing. You basically finance the mortgage insurance into the loan. Speaking of which, their mortgage insurance is a whole lot less than the MFA loan mortgage insurance program. The seller, of course, can pay towards your closing costs. Flexible credit guidelines. Like I said, it's very tight income restrictions, but it's an excellent program. It's a conventional loan. I've put a lot of people in that loan program, and it's just really a great program. But you have to find that you have to have, high credit scores and that sort of thing. So before COVID, it was great. They go down to 620 or below. Now they say they'll go down to 620, but I've tried a couple of times, and it's really not a great program that we could work on under those parameters itself. But it's a great program overall. And the rates are very reasonable. It's a good deal itself. Excuse me, get some water there.
What else do you got for us today, Ken?
Well, one of the things that's really, really important that I want to touch on is kind of outside the box a little bit is the do's and don'ts. A lot of people, what they'll do is they'll get involved and they'll get out there and they'll say, okay, well, I want to buy a house, and they'll start, paying off debt or doing this or doing that. And the fact of the matter is that's really is a mistake. I've got a nice list of items that I'll send you when you're looking to go ahead and buy the house. Part of that list is going to be, don't pay off credit card debt maybe, or definitely don't go out and charge. A lot of people, the loan process, they'll be all excited and they'll go, okay, I'm going to go out and buy a new washer and dryer, just right before closing. That creates new debt. And that's one thing that's horrible, because we have to count all the debt that's in the loan itself. So, if you go out to, I don't know, places to buy washer and dryers off the top of my head, but if you go out and buy a new washer, buy a new refrigerator, say, okay, because I really want to have that while my house is almost complete. We're about a week away from closing. I want to have a new refrigerator. That's a horrible mistake. So some of the things, don't change jobs. Don't apply for new credit card. Don't take any store credit card debt we just talked about. Don't make any large deposits or cash into your bank account. That's one of the biggest problems that people do is they go ahead and let's say their cousin owed them, $500 or $1,000. Well, they want to use that money for down payment. So get the cousin to pay them back, and it's cash, and I can't track that. So don't do any of that kind of stuff. The one we laugh about is people making large purchases. They'll go out there and like, well, I just, I bought a new car. You did what? You don't want to buy a new car. That's a horrible thing to do in our loan process itself. Some of the other things I wanted to touch on real quick. Don't max out your credit cards, we talked about. Don't close any accounts. That's one I was looking for. I had to go to my cheat sheet. Don't close any accounts. A lot of times people think, they know how to fix their credit. And that's why it's important for you to apply online and for us to look at things and analyze it all together. Because if you close an account, it actually drops your credit score. Now, if you pay it down is one thing, that might be good, but don't close it. Don't dispute anything in your credit report. And of course, don't go on any kind of a spending spree. That's a bad thing, but no large deposits. If family's going to give you a gift, then let's talk about it. I'll show you how to do that. There's all kinds of things that we have to control. And it's so important for you to communicate with me to make sure that we don't do anything during the loan process. Jason and I have had several customers that thought they were doing just the right thing, and right before closing, they'll do something, postpones our closing almost a month if we can get the seller to agree to hold off that long to fix things. So let's communicate. Let's make sure that we're doing everything that is going to make sure that you win overall in the overall transaction itself.
Great. Well, Ken, again, just great information. I think what we're really doing through this effort here, and you piggybacked right up onto Jeremy's time, which was great. But what we're really doing in this effort here is trying to dispel the myths. Unfortunately, if you go into the Google machine and you type in, buying a home, there's like 9,000 pages of advice and information that's available. And what that actually creates is an overload of information. So one of two things happens. Either number one, people get scared because there's so much information that they're like, there's no way in hell I'm doing this. Or number two, they get information that isn't specific to them and their situation. And then they start trying to make decisions off of like the 20% down requirement that we kind of talked about. The real value of this right here that we're talking about is you have to find a trusted advisor to be able to pull some information in, look at your specific information. That way you can be set on the path that's really going to make sense for you. Would you agree with that?
Oh, 100%, 100%. And, sometimes people will apply with 3, 4, 5 different mortgage companies thinking they're going to get better rates and better terms. Well, under the MFA program, I just want to add in that MFA sets the rates. So no matter what lender, which you should work with Ken Yelin, of course, but no matter what lender you work with, they all have the same exact rates for these programs that I'm talking about. Now, the USDA has a different rate structure, so that's different. But when it comes to MFA has a website, and you can go to the website and there's the rates. So
Yep.
It doesn't matter which lender you go to, they'll all have the same rates under the MFA program itself. So don't let that change you. Don't go to a bunch of different lenders. If you want, pick one or two. If I said don't apply for credit cards and that sort of thing before, don't do any of that kind of stuff. Just make sure. I do want to jump in and talk about one more program, if it's okay with you, Jason.
Yeah, let's go.
So the other program is we want to talk about is veteran programs, the VA loans. The VA loans are not necessarily a first-time homebuyer program, but a VA loan definitely has a zero down requirement. I will tell you there's a tremendous amount of veterans that do not know or not aware that they can buy a house with zero down payment. If you're a veteran and you have a disability over 10%, then they have what's called no VA funding fee. The VA funding fee is VA's mortgage insurance. On top of that, if by chance you are 100% disabled, then the state of New Mexico does not charge you property taxes, which is huge. And I've a $200,000 house, the taxes are what, maybe $300 a month or 200, whatever. You don't have to pay that. So you can qualify for more of a house for the same payment and be able to get into a house. I love VA loans. I love helping veterans. I've been doing them for 30 years, great loan programs. And I will tell you, I've done VA loans for homeless people. I did a loan for a gentleman that his daughter found him, and what a wonderful story that, I don't have to go on too long about it, but the daughter found him, and he was living on the streets, just real sad situation. And he came into my office one day and sat down, and, he's got absolutely no credit. He's got absolutely nothing. But he does have a bank account because actually he had plenty of money in the bank, but we sat down and we worked it out for him. We had to get a VA exception because he had no credit for, some like 20 years, no home address, whatever. But we worked with him, and we took care of him. And he's right now currently living in a beautiful house with his family, and he loves it. So I love veterans. I love helping veterans. Jason, I know you're a veteran, sir, and I thank you for your service. And I just think it's really wonderful that the things that can be done for veterans to help them. And like I said, if you have a VA disability or up to 100%, there's huge discount. And my company loves veteran loans. We like helping, trying to pay back the small way we can. We have excellent rates for that and excellent programs. The VA, the credit score, according to VA guidelines, there are no credit score requirements, but at overall credit. So if you had a bankruptcy last year, or you did something that doesn't really, so they won't look at that you have to have a credit score, but they'll look at the overall credit itself. But I did a loan for a veteran about 2 years ago. His credit score was 561, but it was 561 because he made some mistakes and he wasn't able to reestablish credit. And he didn't do that. So we worked with him to do that. So I just wanted to put that out there. The VA loans are also a great first-time home buyer program. You don't have to be a first-time home buyer, but the zero down is an awesome program for us to work with.
Well, fantastic. Well, Ken, I'm going to ask you to do me a favor and jump up on the participants and push me back over to being the host, if you would.
I don't know if I'm going to do that, but I'll try it, sir. Yeah, I see it. Okay.
All right. And so you'll kick me on over and make me the host. It should be, when you scroll over my name, there's a little more button with a little arrow. And if you click on it, it should be able to do that. And we're actually going to take a little break. I know I've got some people up on the Zoom, and I've also got some people up on Facebook Live. And want to let you guys know, we're going to take a little break. Our next presentation is actually going to be on is now the right time to refinance? Just some considerations about refinancing and what those options look like. So I'm hoping that I'm going to go take a little potty break. I've been on this call for about 2.5 hours now. But I want to let you guys know we're going to be jumping back on here at noontime with just some general information about is refinancing now the right option. So Ken, thank you so very much. One last time, we got the plug. KenYelin.com. Ken works with a lot of our first-time home buyers, and he can be reached again at 505-220-2968, or you can visit him with an online application at KenYelin.com. That's YELIN.com. All right. So Ken, thank you so very much. Eternally grateful for your commitment to this community. I don't know. Are we keeping track of how many homes we've how many customers we put into homes together? That might be something that's kind of cool. I'm sure we're in the hundreds by now.
Great. We have to go back and check it out. Right.
But a lot of families are benefiting, from your hard work and such like that. And they're not renting because of that. So again, I appreciate that. Ladies and gentlemen, we are on the 2021 Gallup Housing Summit, and we are going to be continuing here in about 25 minutes at noontime with Is Refinancing Now the Right Option? Thank you so much, Ken. You have a safe weekend, and we'll talk to you later, my man.
Thank you, guys. Appreciate it.